On July 29th, the Federal Reserve did absolutely nothing. No rate cut, no rate hike, nothing. Sounds like the most boring news of the summer, right? And yet, on that very same day, the Dow Jones dropped more than 1,100 points. Its worst single day in over a year. The VIX, Wall Street's fear gauge, jumped 7%. Gold shot past $4,100 in ounce. So how does a central bank doing nothing trigger a market panic? The issue is that for the first time in almost 10 years, 3 members of the Fed's rating setting committee openly rebelled. And here is the twist. They weren't demanding a rate cut, they were demanding a rate hike, something markets haven't seen from the Fed in years. And the new Fed chairman, Kevin Warsh, when asked about that rebellion, just smiled and said, quote, "I asked for a good family fight and I got one." A family fight inside the most powerful financial institution on the planet. So today we're going to break down what actually happened, why doing nothing crashed the markets, and what all of this means for your mortgage, your loans, your investments, and for economies all around the world. Stay with me, because by the end of this video you'll understand the story better than most people on Wall Street. And real quick, if you are new here on this channel, I break down the Fed, the markets, and the global economy in plain English every time something big happens. Hit subscribe so the next breakdown lands right in your feed. Let's start with the facts. On Wednesday, July 29th, the Federal Open Market Committee, that's the group of 12 officials who set interest rates in the United States, voted to keep the federal funds rate unchanged in a range of 3.5% to 3.75%. This is now the 5th meeting in a row with no change. The rate has been sitting at this level since December of 2025. And remember the context. In the fall of last year, the Fed actually cut rates 3 times. Then in January, it slammed on the brakes, and it hasn't moved since. But here is what made this meeting historic. The vote was 9-3. 3 regional Fed presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, voted against the decision. So all 3 wanted to raise rates by 1/4 percentage point. Why is that a big deal? Because the last time 3 policymakers dissented together, pushing in the same direction, was September of 2016. Nearly a decade ago. In central banking, that's not a disagreement, that's an earthquake. And the official statement, almost comically short. It ended with one blunt sentence that has become the Fed's new mantra. The committee will deliver price stability. That's it. No forecasts, no hints, no roadmap. And one more detail I love. Jerome Powell, the previous Fed chairman, he didn't leave the building. He stepped down as a chair, but he stayed on as a regular board member. So the former boss is literally sitting at the same table, watching his successor run the show. Now let me do a quick refresher for anyone who needs it. The federal funds rate is the interest rate banks charge each other for overnight loans. It sounds technical, but it's the foundation of the entire financial system. When it moves, everything moves. Mortgage rates, car loans, credit card rates, business loans, government borrowing costs, even the value of the dollar itself. So it is quite simply the price of the money. And right now, the price of the money in America is stuck on purpose. And the main question is why it's happening. Here is the core of the story. Inflation in the United States has now been running above the Fed's 2% target for more than 5 years straight. 5 years. Economists call the result an affordability crisis. For regular American families, it just means everything feels expensive all the time. Now, to be fair, the latest numbers actually looked encouraging. In June, headline inflation slowed to 3.5%, down from 4.2% 3 months before. Core inflation, that's the number without volatile food and energy prices, came down to 2.6%. And get this, monthly consumer prices actually fell in June, the first monthly decline since April of 2020. So you might think, great, the fever is breaking, time to relax. But not so fast, because there are 3 powerful forces pushing prices right back up. Force number 1, war. The conflict between the United States, Israel, and Iran has effectively shut down the Strait of Hormuz, the narrow waterway that carries roughly 1/5 of the world's oil. Brent crude is back above $87 a barrel, and American drivers feel it every week. The average price of gasoline has climbed from $2.98 a gallon before the conflict started to $4.90 today. So that's a 37% jump, driven not by economics but by missiles. Force number 2, tariffs. The Trump administration has rolled out a new blanket tariff of 10 to 12.5% on dozens of trading partners. Those tariffs are already been challenged in court, which adds a whole extra layer of uncertainty. Importers don't even know if the rules they are paying under will exist in 3 months. And finally, force number 3, and this one is fascinating, the AI boom. Companies are pouring historic amounts of money into data centers, chips and computing power. Capital investment is booming, productivity is rising. That's great news for growth, but all that spending is also hit under the economy. And the hot economy makes inflation harder to kill. So here is the Fed's dilemma, and it's a brutal one. Higher interest rates are a powerful weapon against the wrong enemy. As one Wall Street strategist put it, raising rates doesn't open the Strait of Hormuz and it doesn't end the war. Rate hikes cool down demand, but this inflation is coming largely from supply, from oil, from shipping, from tariffs. You can't sink a missile with a rate hike. And yet the hawks inside the Fed are losing patience. Lori Logan of Dallas put it bluntly, every single month of above target inflation compounds the strain of American family budgets. Beth Hammock of Cleveland says the inflation she is seeing is broad, spread across the whole economy, and that businesses in her district are practically begging the central bank to act. 5 years of broken promises on inflation, that's the backdrop. And that's why 3 officials said, enough, raise the rates now. So why didn't the Fed's new boss agree? Well, it's time to talk about Kevin Warsh, because you can't understand the decision without understanding the man behind it. Kevin Warsh took over the Federal Reserve in May of this year, replacing Jerome Powell. July was only his second meeting in charge, and in just 2 meetings he has completely rewritten the rules of the game. The biggest change is that for the past 15 years, the Fed operated on a simple principle: no surprises. Tell the markets what you are planning, guide their expectations, hold their hand. Economists call it forward guidance. And I would say that Warsh has thrown that playbook in the trash. His philosophy is the Fed should stop telling markets what it's going to do next. Policy statements under Warsh have shrunk for a few short paragraphs. Forecasts minimal, hits none. He's even launched 5 internal task forces to overhaul how the Fed works, including one dedicated entirely to changing how the Fed communicates. And the man speaks in riddles deliberately. Listen to these actual quotes. On inflation, he says, inflation is, quote, a choice. Meaning, if a central bank tolerates it, that's a decision. On markets, he says, people are, quote, learning to play the ball, not the referee. Meaning, stop guessing what the Fed will do and look at the economy itself. When asked whether the July decision was a pause, he said, quote, I wouldn't characterize what we did as anything like a pause. It was a rigorous review of the economic situation. And my personal favorite, he calls this, quote, a period of watchful thinking, not watchful waiting. Watchful thinking, not watchful waiting. What does it mean? Wall Street analysts have started calling this style Warshism, and they've hired linguists to decode it. I'm not joking. Now, what does this do to markets? It makes them fly blind. Going into this meeting, traders were pricing in roughly a 1 in 3 chance of a surprise rate hike. 1 in 3. For the past decade and a half, Fed decisions were basically known in advance. Under Warsh, every meeting now is a game changer. But here's the part of the story almost nobody is talking about, and it might be the most important part of the entire video. The Fed has a second lever, and it's enormous. It's called the balance sheet. Over the years, through the financial crisis of 2008 and then through the pandemic, the Fed bought trillions of dollars of bonds to support the economy. That's the famous quantitative easing, or just QE, maybe you've heard about it. At the peak, the Fed's balance sheet hit roughly $9 trillion. It's since been trimmed to about $6.8 trillion. That's called quantitative tightening, or QT, but still a mountain of assets. And here is the thing about Kevin Warsh. He hates that mountain. This is a personal for him. Back in 2011, he resigned from the Fed's board largely because he disagreed with all that bond buying. Now he is back as the boss, and he says that outside of emergencies, monetary policy should rely, quote, almost exclusively on interest rate policy. And he's created a task force to review the entire balance sheet regime, warning that shrinking it will, quote, take years. Why does this matter to you? Because on July 29th, the bond market connected the dots. Traders started asking, what if Warsh doesn't raise rates? What if instead he starts aggressively shrinking that balance sheet, pulling trillions of dollars of support out from under the bond market? As a result, 30-year US government bonds suffered one of their biggest single-day sell-offs at a Fed meeting in over a decade. That's the hidden earthquake beneath the stock market drop. And there is one more layer, of course, politics. President Trump has spent years demanding lower rates. He pressured Jerome Powell. There were even Justice Department investigations. But what about Warsh? Trump praises him. He called him, quote, fantastic, while adding in the same breeze that other Fed board members are, quote, very political. So the question of whether the Fed can stay truly independent is hanging over every single one of these meetings. Put it all together and you get the paradox of July. The Fed held rates steady, sounded hawkish, explained nothing, and markets, instead of feeling reassured, started doubting whether the Fed is serious about fighting inflation at all. Silence, it turns out, can be the loudest sound in financial world. By the way, if this breakdown is making sense so far, do me a favor and tap that like button. It's free and tells YouTube to show this video to more people. Thank you. Okay, now let's bring this down from the marble halls of the Fed to your street. What does all of this actually means for households, business and investors in America? Let's start with the biggest purchase of most people's lives, a home. The average 30-year mortgage rate right now is sitting between 6.6 and 6.8%, the highest in nearly a year. And here's the painful part. Back in early spring, before the war with Iran, mortgage rates had fallen to 5.9 or 8%, a 3-year low. Buyers were finally coming back. The market has towing. Then the missiles flew, oil spiked, inflation jumped, and mortgage rates snapped right back up. The housing market has essentially frozen again. And the real estate agents report that even wealthy buyers in the luxury segment are hesitating, taking longer, negotiating harder. If the Fed hikes in September, mortgage rates could climb even higher. The same logic hits everything bought on credit. Car sales are down. Equipment financing for small businesses is expensive. If you carry a credit card balance, you're feeling it every month. There is one silver lining. If you have savings, high rates mean your deposits and money market funds are still paying you real returns. Savers win, borrowers lose. Meanwhile, consumer confidence has now fallen for 3 straight months. Americans, when surveyed, they say expect little to no improvement in business conditions over the next 6 months. That's the mood on Main Street. But here's what makes this economy so strange. It's really two economies moving at two different speeds. On one side, small businesses and ordinary consumers squeezed by expensive credits. On the other side, giant technology companies swimming in cash, pouring record amounts into artificial intelligence, data centers, chips, energy, and so on. So what we see? Capital spending is booming, productivity is rising, one half of the economy is freezing, and the other half is on fire. And the Fed has to set a single interest rate for both of them. Now here's the hidden victim of high rates that almost nobody talks about, the United States government itself. Follow the numbers with me. The national debt has reached $39.5 trillion. This year's budget deficit is heading towards $2 trillion. The Treasury is borrowing roughly $155 billion every month. That's about $39 billion a week. And what is the interest on all that debt? It cost $970 billion last year. And this year, for the first time in history, it will cross $1 trillion. So if we will try to compare these numbers to something, let's imagine that America will soon spend more just on debt interest than on Medicare. The Congressional Budget Office says that crossover comes as early as 2028. And every month the Fed keeps rates high, the bill grows. So there is a quite structural conflict on interest here. The White House wants cheap money to fund its deficits, and the Fed's job is to keep money expensive until inflation dies. Keep that tension in mind. It explains a lot of the politics around the story. What about markets? We covered the stock drop. Dow Jones down 1,100 points, worst day in a year. Gold about $4,100, investors running for shelter. And crypto? Bitcoin is sitting around $64,000 and notably it did not rally on the decision. So crypto could be treated as a risk barometer these days. Research shows Bitcoin's price swing more than double in the hour right after a Fed statement. When the barometer does move up, it tells you risk appetite is thin. And here is the single most important market signal to remember from this video. Futures market are now pricing in roughly a 90% probability that the Fed raises rates by at least a quarter point before January. 90%. Even the Fed's own June projections penciled in one hike before the end of the year. In other words, Wall Street believes that era of no change is ending. The next move is up. Between now and the next meeting in September, watch for things: 2 monthly jobs reports, 2 inflation reports, and the Jackson Hole Symposium in late August. It will be the annual gathering where Fed chairs traditionally give their biggest speeches. Will Warsh finally show his cards there? Even he says he hasn't decided yet. Of course he hasn't. Now let's zoom out, because when the Fed sneezes, the world catches a cold. And right now the world was already running a fever. Let's start with the dollar. Right after the decision, the dollar posted its sharpest drop in 2 weeks. But the bigger picture is more dramatic. Since its peak in early 2025, the dollar has lost roughly 10 to 11% of its value. That reshuffles everything: global trade contracts, commodity prices, and trillions of dollars of debt that other countries have borrowed in dollars. So the weaker dollar eases the pressure on those borrowers, and unpredictable Fed keeps them awake at night. Second, and this is the big one, the world's major central banks are no longer moving together. For years, they marched roughly in step, but not anymore. The European Central Bank raised rates in June and is now on pause. The Bank of Japan has lifted its rate to the highest level since 1995 and says that more hikes are coming. The Bank of England just held rates in a split vote where, sound familiar? A growing faction pushed for a hike. So the same hawkish rebellion we saw at the Fed is breaking out as central banks across the globe. Economists call this divergence. For currency markets, divergence means turbulence, big swings in exchange rates, which ripple into import prices, corporate profits, and inflation everywhere. Third, and the most important part here, is China. The world's second largest economy is slowing down. GDP growth fell from 5% in the first quarter to 4.3% in the second. American tariffs are biting into Chinese exports, high US rates are pressuring the yuan, and Beijing has less room to stimulate. When the two biggest economies on Earth are simultaneously fighting inflation and slowing growth, nobody on the planet is untouched. Fourth point, and I cannot say about this, is emerging markets. This is the classic transmission channel. When American interest rates are high and unpredictable, capital flows out of developing countries and back into US assets. Their currencies weaken, their dollar-denominated debts get heavier, their central banks are forced to keep their own rates painfully high. The International Monetary Fund now expects growth across emerging and developing economies to slow to 3.8% this year. For countries that need 5, 6, 7% growth to create jobs, that's a serious problem. And fifth, the wild card, is the AI trade. The Fed's decision landed in the middle of an already panicking Asia. South Korea's Kospi index, which had tripled in the year through June, collapsed more than 11% in a single day, on top of 10% drop the day before. Taiwan fell 5%. Japan's Nikkei lost 2.6%. Why? Because investors are suddenly asking whether the trillions being poured into artificial intelligence will ever pay for themselves. And of course, whether tech giants funding each other in circles is real demand or an illusion. And after the Fed meeting, the Nasdaq itself broke below key support levels. So we can say that global markets are now fighting on two fronts at once: expensive money and doubts about the AI boom that has carried stocks for 2 years. And it all up, and here is the bottom line for the world. The Federal Reserve is no longer the world's safety net. For 15 years, whenever markets stumbled, the Fed rode to the rescue with cheap money. But this era is over. Every country, every company, every investor now stands face to face with their own inflation, their own debts, their own risks. The referee has left the field and everyone's learning to play the ball. So where does this go from here? Let me give you 3 scenarios for the rest of 2026. The first one is the hike. This is what markets consider the base case. Remember, 90% odds of a hike by January. If oil stays high and tariffs keep feeding into prices, the Fed raises rates in September. If oil stays high and tariffs keep feeding into prices, the Fed raises rates in September. Credit gets more expensive, mortgages climb towards 7%, stocks and emerging markets feel the squeeze, the dollar strengthens, and Washington's $1 trillion interest bill grows even faster. Scenario 2 is the long pause. If inflation keeps cooling the way it did in June, remember the first monthly price decline since 2020, then the Fed simply holds meeting after meeting. Markets would gradually calm down, except one thing. With worse, silence itself is a source of volatility. And in this scenario, watch the balance sheet. If the Fed won't move rates, quantitative tightening becomes the story of the year. And the third scenario could be the shock. If we will have full escalation with Iran and the Strait of Hormuz closes completely, so oil doesn't just rise, it explodes and inflation follows. In that world, the Fed should be forced to hike aggressively even as the economy weakens. That's the nightmare scenario, stagflation risk, and while it's the least likely of the three, it's no longer unthinkable. So let's land this plane. If you want to remember just one sentence from this entire video, make it this one. The Fed changed nothing on July 29th. And that was exactly the problem. The silence, the split vote, the fog around $6.8 trillion balance sheet, this combination was the news. Markets can price in good news and they can price in bad news. What they cannot price is no news. And Kevin Warsh has made no news his official policy. Now I want to hear from you. What do you think? Will the Fed raise rates in September, or does Warsh keep everyone guessing? Drop your prediction in the comments. I read every single one. If this breakdown helped you understand what's really going on, hit like, subscribe and tap the bell so you get notified the moment the September decision drops, because we'll break it down right here and you don't want to miss it. Thanks for watching, stay sharp, stay curious, and remember, play the ball, not the referee. See you in the next one.